I think it's two things. So the first one is like the China-specific stories, where I think we're in a whatever it takes moment now. They know US elections are coming. Consumer confidence is very low locally. So they need to do something. Then on the other side, you look at what's happening in the US. The narrative is changing at each data point. So we've been shifting from recession soft to no landing week after week. So if you want a place to park the money by the end of the year, I think China makes sense because they are now willing to put a floor and basically reboost their economy in the next 6 to 12 months.
Why bother unless you're going to be successful? Right. The Chinese have done a lot in recent weeks trying to shore up market confidence, move the needle on international sentiment where it's been an uninvestable part of the world for a while. So if they're not successful, why bother in the first place? To me, it seems like they will take things the final mile, hence the scheduling of this press conference when there'll be no other conflict in the news flow. What do they need to say tomorrow that just restores some of the enthusiasm that we've seen in recent trading sessions?
I think it's the amount, but also the focus on their fiscal, like the fiscal package they're going to announce. The market expectation is for 2 to 3 trillion. I think at this point, it's not really the amount that matters. They will do whatever it takes, but I think it's more the focus. Are they going to be more focused on the investment side of things, or much more focused on the demand side, where, as I said, like, consumer confidence is very low. So I think if there's much more money directed towards boosting consumer demand, I think it's going to be a good sign.
Yeah, I wanted to get into how you set up then for the remainder of this year. And very interesting because you make note of how you're rotating particularly out of the overvalued stuff or the expensive stuff. Then where then do you put your money in and what's leadership looking like for the remainder of the year?
So I think the narrative has to do with when you look at the equity bond correlation is back into negative territory. So I think it's giving us full sense of confidence that your portfolio is diversified, bonds are back as a portfolio diversifier. But central banks are already expected to cut back to neutral, which means that for your bond leg to work, you need bad news on the macroeconomic front. And global equity risk premium, like global risk premium overall, is very tight. So you don't want to play a recession right away, but you want at this point to continue having some risk, but having some risk through the cheap part of markets makes much more sense. So I think the pain trade for me by the end of the year will be to be overweight US and underweight Europe and Asia, where you have much more pessimism right there. So I think Europe, like small caps in Europe, makes sense. In Asia, Korean stocks, Chinese stocks. So there's going to be this ongoing rotation going on.